Hello friends, welcome to this edition of Fixed Income Viewpoints and Monthly Outlook for the month of Feb 2020. We have our fund manager Mr. Kaustubh who has joined us. Welcome Kaustubh.
Thank you, Nayan.
Kaustubh, we recently had two big events last week.
Yes.
So the big one, budget 2020. We saw a lot of steps taken in terms of boosting economy, whereas we also saw fiscal going up to 3.8.
Yes.
Would you like to share your thoughts on that?
Look, as far as the budget was concerned, of course the market had very large expectation from this budget. But if you look into the context that this government has been continuously trying to support economic activity by announcing slew of measures right from September of 2019. So, in that context or in series of context, of course this budget, it takes a lot of right boxes. From a fixed income perspective, of course, they have chosen to use the escape clause and they have kept fiscal deficit target for this year at 3.8% and for next year at 3.5%, which is higher than what the FRBM path was laid out earlier. Within this, the government has broadly kept their borrowing numbers unchanged for this year, and even for the next year, the overall borrowing numbers has been in line with market anticipation. Resultantly, markets which were quite fearful in run up to the budget that government may come out with large borrowing numbers has been proven wrong, and thus I would say that from a fixed income perspective, this budget is overall a positive budget.
Kaustubh, when we talk about the borrowing calendar or the borrowing numbers, you rightly mentioned it has been kept within the defined numbers, but we have been reading through articles also about the off-balance sheet borrowing.
Yes.
So, any news or you want to throw some light on that side as well?
See, even on the off-balance sheet borrowing, the numbers are by and large within or better than market anticipation. Thus, I would say that the market which were fearful of longer end of the curve because of pure supply or the potential supply which could come in on account of these government programs has been a lot more contained. And I would say that this should make sure that the longer end of the curve or the term spreads in the longer end of the curve, which were quite high with respect to our historical perspective, they have now ability and space to come off incrementally.
Kaustubh, so when talking about spreads, I mean, want to move on to the next event that we had recently on the policy.
Yes.
As widely market expected, no rate cuts, rather unchanged. But there was a surprise move from the governor in terms of LTRO.
Yes.
I mean, it would be great if you can share your thoughts and what exactly LTRO helps you and how does it work?
So I would say that for fixed income markets, the event which is much more bigger this time than budget is monetary policy. As far as the policy is concerned, they have maintained their stance as accommodative. They have maintained that they want to keep rates on hold. Good thing is that the second part of the monetary policy, where the surprise package came in, where they have announced slew of measures again so as to make sure the transmission happens more effectively. The most important of it was introduction of LTRO. It's kind of an unconventional but time-tested policy tool by other central bankers across countries. Now, as far as LTRO is concerned, in local terms, what they have announced is that they will allow banks to borrow between 1 to 3 years at a fixed policy rate, which is 5.15 currently. Effectively, up till now, banks who were running large SLR, but they were not able to use this SLR to fund the credit growth because they were borrowing it for a short term, and you can't fund these assets which are longer term in the nature by borrowing in short term from RBI. So RBI is assuring them that for next 3 years, the rate for them will remain fixed at 5.15%. Thus, they can reduce their lending rates accordingly by ensuring that the funding cost of the banks doesn't move up in next 3 years. This is somewhat of unconventional. Of course, there was market participants who were suggesting that this is one of the way the easing could be done. But in the backdrop that despite RBI cutting rate by 135 basis point, the transmission has not happened in the commensurate manner given the liquidity was abundant. So after the quantity of money, now they are targeting even the price of money for next 3 years. Thus I would say this cut is as good as anywhere between 25 to 50 basis of incremental policy cuts in intentional terms. And this will make sure that the term premiums or the monetary policy transmission, which was working with lag and which was not being transmitted in fully manner, we'll see that the transmission happens in much more faster and effective manner. Resultantly, 2-3 year corporate bond spreads and govies, they have already rallied by 25 to 40 basis points, and we think that they have potential to rally by another 25 to 50 basis points from the current existing levels. The bigger impact we'll see in the credit space, where the spreads which were quite elevated post the confidence crisis that the country or the financial markets has been witnessing over last 1 year, we could see bankers and capital market at large, they could start chasing these spreads. Thus, we think that these policy measures, they will make sure the transmission in the credit space will happen at much faster pace now with this slew of measures.
That's really brief, Kaustubh. Just one point of concern as well. When we see RBI doing the policy measures taking up, we had OMOs, which will continue, I guess. We also saw Operation Twist, and now the new surprise is your LTRO. But at the same time, we see the inflation bit, which is also inching up.
Yeah.
Growth going down, there are policy measures that have been taken up. But again, inflation is seen as a concern or a cause. So how do you see this?
Look, as far as inflation is concerned, currently the demand condition at local level is improving, but it's not improving at a significant pace. At a global level, because of fear of coronavirus, in fact, the global demand has taken a big hit. And we are seeing that in the commodity prices, the prices have corrected quite significantly over the last 15 days. So large part of food inflation, which was driven by food, especially onion, potato, tomatoes, as the new crop come in, or the impact of unseasonal rains fade away, we think that the food inflation will start reverting to its mean. But market was fearful that it could lead to some bit of core inflation also over going ahead. But this coronavirus impact is making sure that the globally commodity prices are low, and thus the possibility of core inflation moving higher the possibility has inched lower. One need to see that very explicitly, Governor in the post policy conference call, he communicated to the market that there is a space which is available in the policy for ease, but they want to make sure that the space is utilized at the appropriate time and once the incremental data on the inflation comes in. Thus, I would say, to sum up your question, that we think that the inflation, which is quite elevated, we think that for next 2-3 months they will remain elevated, but over next 3 to 6 months this number starts coming off and they will be within the RBI tolerable range. More important, growth continues to be weak, and now we have a global headwinds in terms of what's happening in the China on account of this virus. Thus, I would say that the space in monetary policy on account of these two things, which was somewhat iffy a month back, has opened in a quite significant manner. Just to extend this question one more space is that as far as fiscal is concerned, effectively they have increased fiscal deficit by utilizing the fiscal space, but most of this extra spending by the government is non-inflationary in the nature. They are also ensuring that it doesn't crowd out the private borrowers from the market. So I would say that these are also supply side measures which is taken by the government. Thus in toto, we think that there is a possibility of 25 basis rate cut now, much more than what it was a month or 2 months back. But inflation as it recedes, RBI may act promptly to ease rates by 25 basis points over next two policies.
So Kaustubh, with all that backdrop, in terms of the budget event, the move of LTRO and the policy, how do you see the fixed income markets panning? I mean, you've covered a lot, but just a broad view in terms of fixed income market going forward, and how has your portfolio been positioned, to get adjusted to this situation?
So clearly the term spreads will collapse at least till 3 years. Clearly there will be a chase for good quality carry spreads. Thus I would say that all fixed income products which predominantly invest in these 1 to 5 year corporate bonds and 1 to 5 year mid-yield corporate yield curve, they will likely to do a lot better over next 1 to 2 years. As such, with ample liquidity, and now RBI targeting not only the quantity of liquidity but also the price of the liquidity, it makes sense to increase duration at margin across our portfolios and for our investors too. Thus, I would suggest investors to continue to invest in the longer end or mid to long end of the curve, which means that the funds like ultra short term funds, low duration funds, corporate bond funds, banking and PSU funds, and even mid corporate yield funds or funds which invest predominantly in these mid corporate yield curves, they are very lucrative opportunities incrementally.
Kaustubh, that was quite insightful. Thank you for your time, and I hope our viewers got a lot of information out of this session. Viewers, I hope this is insightful for you guys, and please keep watching more in the coming months. Thank you, Kaustubh. Thank you for your time.
Thank you, investors. Thank you, Nayan.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.